Matt, good to see you. We are diving into the headlines today, what the big, beautiful bill means for your retirement. Washington recently passed what President Trump is calling the big, beautiful bill, which could reshape retirement planning for millions of Americans. I want to start big picture here. What do we need to know?
Well, the big thing is the tax schedule that we had in 2017 is extended. Originally, back in the day, we thought that these taxes were going to away. These were historically low tax brackets, so we need to do our Roth conversions now. But the good news is they are extended. Some things are permanent, other things are not. That'll flesh out more in the future as far as digging into the bill and finding out what is going to stick and what isn't.
All right, we're going to talk more about the opportunities that come with the extension of those tax cuts. But first, I do want to talk about these confusing headlines on taxes on Social Security. The agency framed the new $6,000 senior tax deduction as eliminating taxes on benefits, but experts say it's not that simple. Can you explain?
Yes, unfortunately, it's not an elimination. So this is not permanent. It's not an elimination. It's not for every penny that you receive across the board. It is tiered based on your income. So it's a $6,000 deduction. So instead of being, I got a deposit of $3,000 for my Social Security and I didn't pay any taxes, you're still going to have the same taxes. But at the end of the year, when you file your taxes, if you're a single filer, you can deduct up to $6,000. If you're married filing jointly, up to $12,000. And it is tiered based on your income. So if you're single filing taxes, you get 100% of the $6,000 deduction up until your income reaches $75,000. Over $75,000, it starts to phase out or tier down. Up until 175, and if you're married filing jointly, then those numbers are 150 to 250.
Okay, so I think that begs the question then, does this change how we should be saving for retirement or when we should claim Social Security?
No, it doesn't. It's a marginal impact. If you have $10,000 and you get a $6,000 deduction, let's say you're at a 20% tax bracket. It's $6,000. It's a $1,200 difference in your paycheck or in the funds that you receive at the end of the year when you file your taxes. $1,200 is not going to be significant for most people, especially in this inflationary world. Don't get me wrong. We're glad that we have it and we'll take it all day long. But for most people, it's going to be a minimal impact as far as when you should file Social Security and when you should pull the plug in retirement.
All right, so now let's talk about the big opportunity here, which is the extension of the 2017 tax cuts. These tax brackets will now remain permanent until they're not, right? As you said, Matt.
Yeah.
So why is now still a good time for a Roth conversion, and why are Roth accounts so powerful?
It's still a good time because we are at historically low tax rates. So going back to 1940s, look at that chart, 94%, and this is just federal tax, not counting state. There was a short period of time where Reagan, I see Reagan on the chart there, when he was making movies back in the day, he'd only make 2 movies a year because after that he'd be at the top tax bracket and it would be over 100% when you factored in your 10% for your state. So we are at historically low tax brackets, so we should take advantage of the Roth conversions and contributing to our Roth and building tax-free money. And your second question is, why is it so powerful? Why is it so important? Well, it's like this. We hear people talk all the time about, if I have $10,000 in IRA and then I convert it to a Roth, I pay tax on that. And if taxes don't change, what's the benefit? Well, if taxes don't change, there was no gain, there was no loss because you pay the same tax rate today versus out in the future. And that's if taxes don't change. But I think that's the wrong perspective because you're looking at, you're tripping over the pennies. The bigger dollars are the conversion over time. Right, so you take that $10,000, now it's $8,000, we put it in the Roth IRA. But the idea is over your lifetime or over 10, 20, 30 years, it's going to, triple, even quadruple in money, depending on, how you're investing and how much time that we have. Well, now instead of 10,000, we have 30,000 and you're not paying any taxes on that 30,000.
Right.
So it's just a powerful tool. It's the last bucket of money you normally touch in retirement. There's some variance to that depending on your situation, but everybody should consider Roth conversions. And
and the longer it can grow tax-free, the more powerful it becomes. So Matt, if somebody wants to talk through either, Social Security claiming strategies, which is something you specialize in, or crunch the numbers regarding those Roth conversions, what's the best way to reach you?
Give us a call at 425-256-3105. There's three people to answer the phone. They can get you on the calendar and I'll call you right away. I'm looking forward to catching up with you.
All right, Matt, thank you so much for your time today. I appreciate it.
Thank you, Erin.